It doesn't matter where you start. All that matters is that you start. Hello everyone, I'm Seth. This is Acquired Salary. In today's video, I'm going to talk about savings, specifically where did American savings go? And in order to do this, I'm going to react to CNBC's piece on this. It's a little bit of an older piece, but a lot of the information and stuff that they talk about is relevant today. Before we get into it, if you're new here, welcome. If you're returning, welcome back. With that, let's jump into things.
The American personal saving rate fell to a low not seen since the Great Recession.
I think a lot of people have been just kind of cooped up during the pandemic times, and now we're transitioning plus inflation. So it definitely has been a little bit harder.
Economists look at this savings dynamic in a sort of benign light. Savings accrued over the early part of the pandemic, and that's starting to get spent down. But on a personal level, though, that's not a pleasant process.
This real-time...
From that standpoint, this video came out, sometime in the middle of 2023, something along those lines. I think overall, with what we're seeing in terms of the economic data, people's savings has been entirely spent at this point, which means a lot of Americans have been feeling that painful process of spending their savings.
Dip in saving is stressing out a lot of people.
70% say they are stressed about their personal finances, and that includes 57% of people earning $100,000.
Yeah, 57% of people making over $100,000 still being stressed about money isn't all that surprising, considering the fact that the cost of living in many states is well over $100,000, especially if you're trying to obtain the American dream. A video I posted last week talked about the lowest cost of living states. The average salary needed to afford the American dream was something like $118,000. Yet, in the highest cost of living states, the median salary was just slightly above that. So if you take the median salary from the highest cost of living states and apply it to the lowest cost of living states, then you can afford the American dream. If not, you're going to be living somewhat paycheck to paycheck and kind of struggling.
$1,000 or more. And the main factors contributing to financial stress for the six-figure set include inflation, economy-wide instability, interest rates, and a lack of savings.
The basic necessities of life substantially burden your income. It becomes difficult to save.
That said,
and this is especially true for lower income people, because lower income people, as inflation hits, 8%, 10%, or even some things we've seen 25% on kind of those day-to-day expenses, that continues to take more and more of the lower income salary. It's a higher proportion of their salary gets taken away by those, day-to-day living expenses.
Americans are sitting with a lot more savings than they had in the past.
according to bank deposit records, Americans as a whole are still better off than they've traditionally been. How much?
So obviously this, at this point in time, is old data. And if we take a look at credit card data, credit card balances have definitely increased. So people's savings have obviously decreased, so much so that people are starting to put money on their credit cards and max out credit cards and so on and so forth, because they no longer have the savings to afford things.
Depends on which side of the income distribution you're on. Regardless, Americans across the board were drawing down those savings in the final quarter of 2022. So why did Americans stop saving? And what effect will that have on this?
Well, I'm going to argue that Americans weren't saving in the first place, but we can see what they have to say.
Massive group of people that we call the economy.
My name is Michael, but the interwebs know me as the Bougie Budgeter because I make money easy. I am currently based in Phoenix, Arizona.
The majority of U.S. households use bank accounts. Michael represents one of these households.
I do take about 8% of my total income, and that is to my 401 contributions. My company matches at 8%. I also try to save an additional 15%, as well as another about 10% of my take-home pay I put towards my investing goals as well. So my personal
So from that standpoint, she's going over kind of the fundamentals of, good personal finance. I'm going to show here, jump out of the video and show the financial order of operations, which she seems to be following. From that standpoint, I would assume that she has enough savings to have her deductibles covered, but then she's maxing out her employee match or her employer match with that 8%. I don't know about her debt, but kind of this is the financial order of operations. The Money Guy Show is a really great finance resource. I highly recommend their podcast because it helps you understand what you need to do in terms of maximizing your dollars and how far they go. And from that standpoint, after you get your deductibles, employer match, and high interest rate debt paid down, then you can start building up your emergency reserves or your war chest or your contingency plan if you lose your job, something along those lines. And then, Roth, HSA, again, all of these have their benefits when it comes to building your savings and being able to retire eventually one day. And from that standpoint, the percentage of your income, I think this lady's going to talk about it, but from that standpoint, if you want to, live a really good retirement, something like saving 25% of your income should be the bare minimum goal. But if you can, and you want to have a really nice retirement, saving something closer to 50% of your income is where you want to target. Obviously, it's not possible if rent is taking up 50% of your income, or your fixed expenses for the month take up 50% of your income, then, you don't have that ability. But that's where it becomes so important to focus on increasing your salary. But let's continue with the video.
Savings rate after my take home, I shoot for about a 15%, and I have my
That's
savings auto deposited right into my high yield savings account, because if I do not do that, then I will accidentally spend it, and I am a recovering overspender, and that was my solution to not overspending.
Yeah, what she's talking about there is, it's kind of along the lines of the rule from Atomic Habits. You're going to fall down to the systems you have in place. So implement systems that are going to make you successful. From that standpoint, if you want to save and you don't have your savings automated, your actions are saying that you don't actually want to save, because you can pretty much have a 100% adherence to saving so long as you don't actually touch your savings account, but you're going to automatically have 100% adherence to having your savings deposited. Then it's just on you as the individual to not touch those savings to actually save money.
Collectively, Americans have trillions more in savings than they did prior to the pandemic.
For a broad swath of Americans, their financial condition is still probably better than it was pre-pandemic.
But
I don't think very many people think that at this point in time, but overall, yeah, there was a short period of time where people were feeling slightly better off than they were before the pandemic, but certainly now with where inflation's at, and especially the job market, not so much.
Those cash cushions are deflating for the first time in years. The personal saving rate reflects how much income Americans hold onto after their taxes and regular spending.
It's basically just the amount of that is not consumed.
Much of that income, particularly for what I define broadly as underserved communities, tends to go toward basic necessities like housing, food, healthcare, transportation.
In February 2023, the personal saving rate was hovering around 4.5%. That's compared to a long-term average of just under 9%.
So this doesn't make much sense in terms of, if we were looking at the amount of deposits in banks being so high, yet the personal savings rate decreasing. It just shows that the adjustments made by people during COVID from, saving their, checks that came from the government doesn't mean they actually changed their habits. So that's why we're not seeing any saving whatsoever. If anything, it worsened the savings rate because people feel like, oh, I actually have savings now. Well, from that standpoint, we're still saving about half as much as we used to on average, and even still, that 9% is not great. And again, speaking to this, 4.5% of people actually are saving. Well, again, inflation is kind of eating into people's ability to save because they no longer have as much buying power. So it kind of makes sense that the savings rate has decreased from the inflation side of things as well as the habit side of things. If they weren't saving in the first place and now they actually had some sort of savings, they don't feel as much pressure to continue saving.
You would see spikes around the dates when those stimulus checks were sent out and those were not getting spent. Of course, the other thing that happened early in the pandemic is people were not spending money on the things that they were accustomed to spending on.
As inflation has set in, the monthly saving rate has taken a tumble. This rate only describes 1 month of earning and saving. Take a look at the total deposits held by customers at banks, and you'll see that there's way more value in people's accounts than any time before the pandemic.
But as we can see, this old data, it was starting to dip, and based off of the credit card balances that we're seeing in most recent data, the opposite is probably true at this point. People are probably back down to those low levels.
A lot of people would point to excess savings that occurred early in the pandemic. Something like $2 to $2.5 trillion in savings above what we would have otherwise expected were saved by American households. Over the past 9 to 12 months, that stash of savings has eroded. It's probably somewhere in the $1 to $1.5 trillion range.
You had folks across the country accumulating a bit of a war chest of savings, and that really...
Yeah, so this is like your emergency fund, which is very important to have, especially in times of economic uncertainty. Like our economy has been flirting with recession over the past 2-3 years. And so people are going to save more to hopefully avoid the recession knocking them out and really hindering their ability to build wealth and so on. But overall, I don't like the term excess savings. I don't think you can have too much money saved up because there's no telling how long you can be out of a job if you lose it, especially with the advent of AI. AI is replacing a lot of jobs, so it might take you a little bit longer to find a job because you have to upskill and taking classes or getting certifications, and that takes time. So first you have to get the certification, then you have to, build the network in order to get the job. So there's no such thing as excess savings, even though they talk about it in this video quite a bit. I wouldn't say excess savings. I would say, it's just being smart.
Really has helped to buoy the economy, particularly in a place like the U.S. where consumption is such a big part of GDP.
The top half of earners have over $1 trillion in excess savings. That's nearly 3 times as much as the bottom half, according to federal economists. But they believe the lower half still collectively holds hundreds of billions in excess savings. By their count, it breaks down to about $5,500 per household.
But in reality, $5,500 per household in excess savings is not true because the average American cannot afford an unexpected $1,000 expense. So from that standpoint, this excess savings is not necessarily liquid, and it's not easy to access to pay off that unexpected expense. And even still, high deductible healthcare plans, I haven't seen a deductible below $6,000 on those high deductible healthcare plans, which means even with all of your excess savings, you can't afford a catastrophic event happening to you, which is why it's so important to have those emergency reserves and savings on top of that.
A note here, this may not mean that you have $5,000 in spare cash laying around. It may have gone to pay off that amount in student debt, or a mortgage, or a car, or towards your retirement.
37% of Americans have not touched their pandemic savings.
That's not true.
45% of Americans either haven't touched it or have taken out a little bit, but the majority is intact. Only 17% of Americans have pretty much exhausted their pandemic savings.
Yeah, at this point, because these are old numbers, I would think the pandemic savings has been exhausted for the majority of people, like probably over 50% at this point.
Though that cushion may be beginning to shrink.
Inflation and the implications for that across categories, whether it be food, whether it be fuel, whether it be rents, you're seeing cost inflation that eats into clearly people's current income, but also to the extent they have savings, it also eats into those savings because everyday things are just more expensive. And if you think about in a pre-pandemic world, a typical black family had about 5 days of liquid savings. There's not a
5 days of liquid savings means that is missing 1 week of work unpaid. That is not enough savings to survive any sort of catastrophic event or job loss. This is why it is so important to actually save and build up a war chest or an emergency fund in case anything unexpected happens. You don't get entirely wiped out.
a whole lot of financial slack in the system to be able to weather periods of time without income.
Economists believe that the extra savings have so far kept people spending and the country from recession. At the same time, a huge swath of the population is living paycheck to paycheck, according to recent surveys.
Take a look at our poll of 1,000 people across the country. What you'll find is that 69% are pessimistic about the current situation in the economy, and they're pessimistic about the future. That's an all-time high.
I think the consumer is doing pretty well. The concern I have is that the whole world is talking about this recession that we're going to have, which we were supposed to have last year, then we were supposed to have the first quarter of this year, now we're supposed to have it the second half of this year. Sometimes when you scare people enough into thinking there's going to be a recession, they will stop consuming, and it can be a self-fulfilling prophecy.
Yeah, there's plenty of stories. There's a really good story of a kid, and it's just about the self-fulfilling prophecy of recession. You know, the kid goes off to college, dad owns a business, kid comes back from college and says, oh, the economy's looking uncertain. We need to, tighten down the hatches and, not spend as much. And, from that standpoint, if you stop spending as much, then other businesses don't receive that income, which means they have to stop, investing in, hiring new employees and that sort. And it can be a self-fulfilling prophecy. However, at the same time, if we look at the most recent FOMC meeting minutes, the Federal Reserve TLDR in their summary said, oh, everything looks fine. We're balanced. We're not worried about inflation and we're not worried about the job market. But if you look into the finer details of things, they're starting to become a little bit concerned about the labor market. And the thing about the labor market is a deterioration in the labor market is really hard to reverse. So the Federal Reserve has a very difficult time in making policy decisions to prevent deterioration in the labor market without also spiking inflation, because the Federal Reserve has a dual mandate, that is stable prices, so not too much inflation, not too much deflation, as well as full employment. And at this point in time, especially with the government poll workers and all of that, it's looking like potentially in January we might be entering into a recession due to the loss of jobs, because the most recent labor report showed a decrease once you adjust out for the government jobs that were created for the election. So it is certainly true that we don't want to self-fulfill a recession, but it's important to be mindful.
Economists note that the low interest rates of recent years are backstopping many Americans. When this rate goes to zero, the cost to loan out cash declines. And you can see the effect playing out on this other chart. Personal interest payments sank below longer-term trend growth. With these excess savings, the economy remains strong, but they expect those stockpiles to dwindle rapidly. These dynamics are observable around the world. Nearly all developed countries have declining household savings. Back in the States, trouble in the regional banking sector may affect the future direction.
Yeah, from that standpoint, trouble in the banking sector is something that caused the 2008 recession, and of course people like to look to this year in the Federal Reserve dropping interest rates by 50 basis points on the same FOMC meeting minutes, same exact date as the 2008 recession date of when they dropped 50 basis points. But things were systemically quite a bit different. We had seen a lot more banks collapsing. We have seen some trouble in the banking sector, but it's not near as bad as it was in 2008 because of the subprime mortgage crisis. So the banks are seeing some trouble, but they're not in near as much trouble as they were in the 2008 Great Recession. So from that standpoint, we do have that going for us in terms of systemically some things have been changed to where we're not going to have that be the cause of recession. So
of interest rates.
The Fed's trying to slow down the economy. That reduction in lending by regional banks might very well do that.
This
work
is
for
monetary
which means
policy.
That we may be near the end of interest rate hikes.
The Fed's interest rate can affect how much money you make from saving. When the rate goes up, putting money away becomes more valuable. But if it goes down, that could change what your account offers in terms of interest.
When you are in a rising interest rate environment, savings rates do tend to lag that process. So right now the Fed has rates close to 5%. I doubt that very many people can get a 5% savings rate on a typical savings or checking account.
It's a lot happening right now. People are losing jobs. There's just so much happening that it's okay if you're not having a 15% savings rate, but just as long as you're starting somewhere.
There are many different ways.
That's an important point to make. It doesn't matter where you start. All that matters is that you start. Starting is the hardest part. And as soon as you start, you can start to improve upon your habits and make it to where you build really good personal finance habits and learn the lessons that you need to so that you can pass it down to your kids if you ever end up having them, so that you can help build generational wealth. Because the one thing that can't be taken away from you is your lessons and your skills that you learn. And if you pass that down, you're going to, make it so that your kids can have a better life than you did.
Ways to save your money. But different methods can generate returns for you as a saver in the form of interest.
There's no easier way to save money than to have money taken out of your paycheck before you get it and have it go into a retirement plan that's either getting
Exactly what we talked about at the beginning of the video, automating the savings process.
a tax deduction plus tax deferral, or it may just be tax-free for life if it's a Roth. But either way, the money's taken out first.
Cash stored under your mattress effectively delivers a negative return, at least when the U.S. has inflation. As prices rise,
Which, although the Federal Reserve doesn't talk about flexible average inflation targeting, they did talk about it at one point in time where they wanted to target over a 10-year period, the average inflation rate was 2% per year. So if you're holding on to cash, your cash is becoming 2% less valuable. It's losing 2% of its buying power each year. This is why it's so important to invest your money properly. And obviously I can't give personalized financial advice, but one of the things that I started doing was investing in an S&P 500 index fund, because the average rate of return is something like 8%. So if you do the math on that, at the age of 20, every dollar you put away by the time you retire is worth $77. And this further helps to refine the lesson on compounding interest and how important time in the market is over timing the market, because over time, by the time you're 30, every dollar you put away is $33, which is less than half of that. So that additional 10 years of saving and investing can really have an outsized impact on how much you have saved up for your retirement.
Your old money is worth less. When it comes to your standard checking account, big banks like Wells Fargo, TD, Chase, and Bank of America routinely offer low returns. By contrast, high-yield savings accounts can deliver much more in interest.
The national average is incredibly low. I'm high yield all the way, especially for any dollars that I'm trying to save. I suggest always any short-term savings, any long-term savings. I'm not a fan of leaving in a savings.
Yeah, long-term savings you want to put into something, long-term being something certainly over 2 years, looking to, not need to access that money for at least 3 years, if not up to 10 years, because, the market is volatile and there is risk in any investment that you make. But longer-term savings you want to certainly have in something that's going to gain you a higher return on investment than high-yield savings accounts.
Savings account, but anything that's between 6 months to 24 months, leave it in a high-yield savings account.
The national savings interest rate was less than 1% in 2023, but some high-yield accounts were netting 4%. That's much better than in the past, but still lower than inflation.
And you may be shocked that you're still getting 0.1 or 0.3%, and you can easily get north of 4% without taking any undue risk on your cash. That's a game changer.
But in reality, if you're getting 4.5% and inflation or CPI is 5%, you're netting a loss still. You're still losing 0.5% of your buying power each year, which is why it's important to establish yourself to be able to invest long term so that you can have interest accruing higher than the rate of inflation, so that you actually are gaining buying power or building wealth.
But not every bank offers a high-yield option, and not everyone seeks them out. Roughly 6 million Americans were unbanked in recent years. This means they don't use checking or savings accounts.
That's a little bit silly, but obviously there's reasons. Some people don't understand FDIC insurance and how up to $250,000 of yours is, fully backed by the federal government. So if the bank collapses, you can get up to $250,000. And then, from that standpoint, that really should eliminate the primary reason that you shouldn't be banking is mistrust of the banking system, because it's backed by the U.S. government. However,
the most common reasons were lack of funds, or they simply don't trust banks.
Not having adequate funds to maintain minimum balances makes sense as to why you are not banking. But the goal should be to increase your income so that you can meet those minimum balances and continue to bank so that you can, improve your personal financial situation.
You've got to reset the thresholds to make sure banking is not burdensome to these individuals, particularly for folks who have lower income, lower net worth. To the extent that they are banked, their money sits in checking and savings accounts.
I think it's probably the case that a lot of families are leaving some money on the table. A high-yield account is going to also offer a better rate than you might get with a typical savings account. You might often have to have a larger balance in that account to qualify for the higher rates.
I had one of those moms who was also a money nerd, just like me, and she had a high-yield savings account back in 2006 when this high-yield savings rate was 8%.
Banks are offering higher returns.
And this is the point that I was making earlier. You can see her mom learned important lessons about personal finance, and she taught that to her daughter, and now her daughter is, starting to become an influencer and helping people learn and understand how to improve their personal finance situations by teaching the fundamental lessons. So it's important because our education system is not very good at teaching personal finance. So it's kind of, the burden is on the parent or the individual. If the parent doesn't know it, they can't teach it, which just leaves it to the individual, which is why it's so important that there are so many resources out there, like the Money Guy Show, as I was mentioning earlier, and all these finance YouTubers. They can, not every piece of advice a finance YouTuber gives is perfect and great. However, having that perspective and consuming multiple forms of information can be very beneficial in terms of finding out what works best for you.
For two reasons. Number one, they're competing for your business. And number two, the interest rate hikes out of the Fed make it easier for them to lend to you at a favorable rate. Smaller banks often use this strategy to build their deposits. Even companies like Goldman Sachs have used this tactic, and companies like Apple are getting into the game as well. Other products like certificates of deposit can make your money work for you.
I actually got my first CD by myself without my mom. I was like, you know what? I'm probably not going to use this until I graduate, and I'll let that mature. And I know that that rate is locked in, which is a lot different from a regular savings account where that rate is not locked in.
A CD usually carries a higher interest rate, but it also has a fixed term. So your money's going to be tied up in that product until the term ends. So there is a give and take there, but I think for a lot of households, if they have the cash to invest over a certain period of time, the CD is a really good option right now.
But no matter how you get it done, saving at all is a good start.
Compound interest is real. So to
Yeah. Again, as I said earlier, starting is the most important aspect. You know, beginning to learn about personal finance and starting to automate your deposits into a savings account is so important. And he's going to kind of reiterate the point that I made about compound interest being so important, because it's, again, time in the market, not timing in the market.
the extent that you can put some amount away, even if it's below the threshold that you had set out maybe a year ago or 2 years ago when the environment looked very different, that's okay.
Don't be hard on yourself. Saving $1 today is still more than saving $0 today. So if you can only start small and let that habit grow, you're still doing amazing.
Again, even if you're starting with $1 and you properly invest it in an index fund that tracks an 8% market appreciation per year, that'll turn into $77 by the time you retire. Overall, what do you think? How are Americans doing on savings? Are you doing well? And do you feel the pain that this video talked about in terms of not having that savings and drawing down that savings from the pandemic? Please share your thoughts and comments in the comment section below. And if you've made it this far into the video, you may as well subscribe to this channel so you don't miss out on future videos just like this one. And if you will, drop a like on the video as well. Until next time, thank you.